Another week, and yet again, interest rates are at the lowest point they have been in all of 2025. So rinse and repeat from last week, it has been a great week for interest rates. We are continuing to trend down, and we are going to dig into the numbers why. And we're also going to point out, hey, where do we think the bottom is, and do we have the potential to go back up? So today, interest rates are ranging right around 6.25, 6.3% according to Mortgage News Daily. Of course, this is contingent upon FICO score, loan-to-value, loan program. Remember, conventional FHA, all of that does matter, right? But right now, 6.25, 6.3, that is where we are ranging, and those are yearly lows for 2025. Not yearly lows in the last 12 months. October of last year, we saw interest rates hit about 6.11%, which was essentially our 3-year low. Don't forget, interest rates have been above 6% for 3 consecutive years. The lowest we have been in 3 consecutive years is 6.11%. We saw that last October. Looks like we are headed in that direction right now. Why are we headed that direction? It is simple. Labor market, labor market, labor market. Okay? So we are continuing to see a softening in the labor market. I want to make one point incredibly clear about my belief, though. Okay? This isn't necessarily what everyone always agrees. I truly believe the labor market's fine. A lot of people are saying, hey, the labor market's this, we're going to be recession, right? No, I believe the labor market is 100% fine. I believe it is absolutely softening, and I believe it is hard to find a job if you don't necessarily have a job, right? That is where we are seeing the growth pains of the labor market, but you're not seeing mass layoffs at this moment. And then remember, okay, when it comes to the labor market, there's one industry that matters the most. We've highlighted this in the past. Residential construction. If you look at the residential construction labor chart over the last 30 to 50 years, every time you start to see residential construction start to have significant layoffs, you then start to see jobless claims rise. When you start to see jobless claims rise, you likely see then it leads to a recession, okay? It is a cyclical pattern. It has happened multiple times over the last 30 years. And that is the trend we are starting to see. So residential construction has actually had its peak. It was March of this year, peak in employment. It has come down for 4 to 5 consecutive months, meaning more construction jobs are being lost month over month for the last 5 months. You can actually add it up. 44,000 jobs have been lost in the residential construction market, okay? 44,000 over 5 months, you know, you're talking 8,000, 9,000, not a ton of jobs. Remember, that don't get me wrong, still very important. I'm talking just straight macro numbers here, okay? I don't want anyone to lose a job. Macro numbers. So not a ton, right? 9,000 jobless claims today had a massive spike to 263,000 jobless claims. So if you're at 9,000 of that 263 is residential construction, not a ton, still modest numbers. But again, 4 or 5 consecutive months of decreasing residential construction. And this is a pattern, 5 months. We haven't seen this pattern in a while. The question here is, and the belief with me is, there's a backstop, right? Again, a lot of people think, hey, you continue to have job loss. Yes, when we continue to have job loss, that could possibly lead to a recession. Well, guess what? As we're having this job loss, what have we seen interest rates do? We have seen interest rates come from that 6.875. We also see the Fed. Remember, the Fed meets Wednesday next week. They are going to cut interest rates, 25 basis points. It is guaranteed. It is locked in. They are going to cut interest rates again in November. They are going to cut interest rates again in December. So 25 bip cut, 25 bip cut, 25 bip. It is going to happen. When you lower interest rates, what does that do? That serves as a backstop. Lowering that increases probably, maybe, residential construction, because as interest rates fall, buyer demand goes up. As buyer demand goes up, why is buyer demand? One, people just want to buy more with lower interest rates, but then 2, people can afford more. It becomes very difficult to afford mortgages at a 6.875. Much easier at a 5.99, even easier at a 4.99. Again, we're not going there. I'm saying it becomes easier. Obviously, you can see the pattern. So as interest rates come down, maybe that gives ammunition to the builders to want to continue to build more, maybe not lead to layoffs, right? So there's a backstop to all of this. So that's why I'm here to say, yes, I truly believe We've talked about in the past. Q3, Q4 was always our time frame. We knew interest rates were going to come down around this time. We know Fed cuts are coming. I believe there's going to be a backstop, right? What that means is, yes, we're at 6.25. I am not saying when. Okay, I'm not saying when. I do believe that at some point interest rates will hit a 5 in the next 3 months, 4 months, right? So we'll get down to that 5.9 level. That is, again, just an opinion. But again, backstop here, interest rates. Then you have labor no longer weaken as much. Labor no longer weaken as much. Guess what? Then interest rates don't have to fall as much, because guess what? We also have increasing inflation, right? Inflation came in today at 2.9%. That is pretty high. It was at 0.3% month over month. Rounded, maybe even 0.4%. That is a sticky print. We do not like inflation at 2.9%. With inflation high, labor rules over inflation. Remember, dual mandate. Inflation and labor, okay? Labor is 100% more than inflation. So labor is getting softer, so guess what? Interest rates come down. If labor eventually hits that backstop, the interest rate's coming down and inflation is still at 2.9%, guess what? That means they can remain flat, maybe and slightly go up again. So again, our number range, 5.875, 5.9, that is where we believe we're heading. But then we really, really need to evaluate the data at that moment. Overall, still great positive signs for the mortgage industry and the real estate industry. We are seeing interest rates come down. You're seeing more buyer activity. Hope this helps. We hope it continues to help. But again, be optimistic. But, also want to be very honest. I don't think we're going to see 4.875, 3.875. Those times are gone, right? Expect reality. Again, we've been above 6 for 3 years. We're not just going to go to 3. We're not just going to go to 4. It's going to take significant time to ever get down to those lowers. But doesn't mean we can't start with the 5 in the near future. So if you have any questions, feel free to reach out.